Hello and good evening. Welcome to the second in our series of Google Plus versus debates. I'm Jemima Khan from Intelligence Squared. I want to welcome all of you here at the live debate and also to all of those of you who are joining us from around the world. You who are joining us online will be able to vote, you'll be able to interact with our panel, you'll be able to ask questions, and I'll be fielding those questions from the Hangout. And in the meantime, I'm going to hand you over to our very capable host for the evening, Emily Maitlis.
Thanks, Jemima. It's hard, isn't it, to think of a more current or contentious subject than the one that we shall be debating here tonight. The motion, austerity is not the answer. The Eurozone crisis has dominated our headlines for nearly 1,000 days and redefined the politics of the entire continent. The ejection of George Papandreou in Greece, Berlusconi in Italy, the arrival of the technocrats, and more recently, the advent of François Hollande last month in France on that anti-austerity ticket. Angela Merkel's loss of the key state of North Rhine-Westphalia to the Social Democrats and the Greens, and the arrival of the anti-bailout Syriza party from the populist left in Greece. Well, whether it's recapitalisation of the banks, the rise of extremist parties on the left and right across Europe, the fall of heads of state, or the terrifying unemployment figures sweeping parts of Europe, there's very little the crisis hasn't touched. Tonight, with voices from right across the continent via the Google Hangout, and here with me in the studio, we'll ask if we're on the right track. Is Plan A, fiscal retrenchment and prudence, the wrong plan? Or maybe we need to do it twice as fast. Is there genuine choice between austerity and growth? Does Germany have a responsibility to support the failing countries with all that firepower of the ECB? Or does that merely create moral hazard, worse crises in the future? Will the discipline of German monetary and fiscal policy break the Eurozone? Will it keep Europe unnecessarily depressed for years to come? Or is there that middle way, a sunshine path that leads us to a bright future of a well-governed, responsible, prosperous union of democratic states? That was what the EU was always supposed to be. You'll hear hardline views on both sides and nuanced views. And all we're asking tonight from wherever you're watching is that you keep your mind open. You might think you know what you think at the beginning. Just see what you think at the end. We're not trying to push answers. We're trying to foster the debate tonight. And you can reward those who argue well and convince you, even if you surprise yourself. So we'll ask you to vote at the beginning. We're asking you to see what the temperature is, really, and we will bring you that result halfway through the debate in about 45 minutes. We'll then take the vote again as we hear the conclusions right at the end. Come back to our YouTube page tomorrow to see where your final vote ended. And we're going to start with our two advocates now for and against the motion. In a moment, you'll hear from Martin van der Weer, business editor of The Spectator. But first, please welcome Oliver Cam, Times leader writer, who will tell us the motion why austerity is not the answer. And Oliver, welcome. You have 3 minutes.
Thank you, Emily. Ladies and gentlemen, there is one point on which we can agree in this debate, and that is that the advanced industrial economies have a problem of too much debt. The economic crisis afflicting the Eurozone is primarily a financial crisis, and financial crises always come down to too much debt. The reason for the debt crisis relates to policy blunders way back in the past. Governments assumed that they had tamed the business cycle and that therefore, if tomorrow was bound to be better than today, what was the point of saving? And banks profoundly misguidedly assumed that the development of complex financial instruments had reduced the risks of lending. Now we are paying the cost, and there is no alternative to getting to grips with the debt crisis. That's not at issue. The issue is the means by which economies, and specifically the Eurozone countries, are going about it. To those who believe and recognise the productive potential of competitive markets, the gains from an open trading economy, it's almost as if the stereotypical views of Professor Noam Chomsky have come to reality. The taxpayers are bailing out the profligate mistakes of bankers. And this is a profoundly damaging political scenario as well as an economic crisis. For the highly indebted economies of the Eurozone, they do have one advantage, which is that the structural reforms they are undertaking, they know they can tackle without suffering a run on the currency. But there is a corollary, which is that one means of restoring competitiveness and stimulating growth is not open to them. The option of external devaluation is not open to countries that are part of a currency union. I'm not arguing that devaluation is some sort of economic cure-all. It usually isn't. It can work in principle by cutting real wages, provided that nominal wages remain constant. But that option isn't open to the indebted Eurozone countries. What has to happen is some easing of the terms of austerity that doesn't crush growth, so that they can make the structural reforms to put their economies back on track. That is not happening at the moment.
Oliver Kahn, thanks very much. Too much debt. Clearly recognise what is at stake then is the issue of how we deal with it. Martin van der Weyer, your response.
Thank you. Well, ladies and gentlemen, let me introduce some simplification early on into this discussion. What is austerity? Austerity is not the answer we're debating. Well, what do we mean by austerity? What is it? Austerity is clearly something that's uncomfortable. It may fall unfairly. It may punish the young unemployed more than it punishes the greedy banker. But it isn't fundamentally a breach of anyone's human rights. Austerity in this debate has become a substitute, a synonym for less emotive terms, for fiscal discipline, for fiscal responsibility, for good government, and to put it in the simplest possible terms. All governments, in all circumstances, need to manage their debts in such a way that they're sustainable over the economic cycle, in such a way that markets are prepared to continue to lend to them at rates that they can afford to borrow at. All governments need to spend frugally, to collect taxes efficiently, and indeed all citizens need to pay their taxes to be decent citizens. Welfare has to be offered at sustainable levels, or the whole structure cannot go forward. So fiscal responsibility is not nearly such an emotive issue. And there was, the background Oliver has explained very well, but there was until just recently a fair consensus, you might say, between the IMF, between the technocrats in Brussels, between Angela Merkel and other European leaders, that austerity was a first and necessary condition of any restructuring of the European economies that have been so badly afflicted by this financial crisis. Now, what has changed in the last few weeks? The fundamentals of that view have not changed. What's changed is the levels of emotion have changed. The voting patterns have changed. The victory of Hollande, the uncertain outcome of the Greek situation has caused this kind of wave of emotion that austerity and growth are opposed to each other, that austerity is somehow an affront to the peoples of Europe, that some other solution has to be conjured up through euro bonds, through other kinds of mechanisms, which no doubt we're going to touch on. Well, besides that debate opening up, fortunately another debate has opened up in the last few weeks, and that is about the very future of the euro itself. And we cannot discuss the one without the other. So I hope the way this evening's discussion will develop will be to really address the future of the euro, because I think that's in question too. Thank you.
Martin, thanks very much. Well, we've heard from both our advocates, and we're going to move on to the next stage of the debate, in which they now bring in and question our witnesses from right across the world. Oliver, the floor is yours. You can cross-examine, you can examine, you can choose your witnesses however you see fit to reinforce your own argument.
Emily, there are diverse views on the crisis and on basic economic principles around this table and among our guests. One thing I would stress immediately is that it's not part of my case that governments need not match their revenues and expenditure. I believe that governments should operate a balanced budget over the course of a business cycle. I'm not arguing for permanent deficit financing or anything like it. But I'd like to turn to Eric Bergloff, Chief Economist of the EBRD. Eric, what do you see as the policy options open to the highly indebted economies in Southern Europe?
Yes, these countries do have too much debt. And then you really have three choices. You have the choice of reducing this debt and restructuring the debt. You have the choice of going for growth, you have the choice of austerity. And we have sort of ruled out, for the moment at least, the restructuring of debt. The growth is not happening because this debt burden, this debt overhang, as we say, is just paralyzing growth. Then you have austerity. Austerity, I think we all agree, and as you said, we do believe that some degree of austerity is needed. But the problem is that when you are in recession and you impose austerity, you can actually worsen the problem. You can actually, there will be what we call a negative multiplier, and that will be particularly strong when you are in a recession. So again, austerity, we need some of it, but I think we are at the moment seeing too much of it.
The quandary of the highly indebted economies, as I see it, is that their economic growth is sharply negative. Their economic variables are all contracting sharply, with one exception, which is the debt burden. That there is some measure of debt restructuring, but because the economies are contracting to such an extent, the debt burden is increasing. Is that what you're referring to as the problem of debt constraining growth?
Well, the problem is that you need revenues, and when you don't have any growth, you don't get any revenues. And this is exactly what happened after the crisis. In the first leg of the crisis, we had a very dramatic reduction in the tax revenues. And that's, the more austerity, the less tax revenues, and we get into this trap, austerity trap.
Thank you. I'd like to turn to Ian Goldin and ask, Ian, can you give some historical insight into the way that countries in these circumstances have tackled the problem? What lessons can we infer?
Yes, the terrible tragedy is that countries around the world have learned that austerity is not the answer. Over 50 countries have been through debt crises and have come out the other end. And what they've suffered is a lost generation. Lost generation of people not being educated, infrastructure not being built, and the fundamentals of growth not being restored. And that's why now in the crisis, they are not simply imposing austerity. They are also engaging simultaneously with all sorts of structural and stimulus measures which ensure that they safeguard it. We in the rich countries, unfortunately, haven't learnt these lessons. Some of the institutions have. The IMF now is not even pushing straight austerity packages on many countries. But we need to learn that austerity alone is not the answer. And the motion is not that austerity is part of a package. The motion is that it is the answer. And I would suggest that that is suicide for countries. It cuts the very fundamentals of growth. It cuts the basis of prosperity, and it leads to great inequality. It also leads, as we know, to a downward spiral in the political economy. Only 4 European countries have survived the crisis intact in terms of the democracies still being in place that were there at the outset. Those are under challenge. And what we see is society is becoming more fractured, xenophobia, nationalism and protection rearing its head, and the downward spiral, not only in the basis for growth, but in the basis of political economy to form a consensus for future avenues. So I think it's very clear from history and from the current experience that austerity alone is not the answer.
Thank you. If I may, let me come specifically onto that point of the political complexion of the countries experiencing these ructions. A number of the countries of the Eurozone have, within the last 50 years, suffered non-democratic governments and have made great strides with very good governance. Spain is an example, to integrate themselves into the European family of nations, never mind the European Union. It's interesting that the most severe political fallout so far in terms of change of government as a result of this crisis has been a change of government in Ireland, where, in my view, the perfectly reasonable demand to renegotiate the terms of the bailout package inflicted a great political defeat on the Fianna Fáil party. How worried are you that ugly sentiments in Europe, such as some parties in the Greek election, may come to the fore as a result of misguided economic austerity?
I'm very worried. We've learned from history, we learned from the causes of the Second World War, that these factors do lead to political extremism. And I think it's incredibly important that for those of us that believe in the European project, but also believe in democracy and the ability of societies to deal with the basic needs of society, which is give people jobs, give them opportunity, and have an opportunity in the future to ensure that they develop as well as deal with the other crises, the systemic risks of climate change and the many others, one needs in place governments that have coherence and the ability to not only finance, but to work across society on these biggest challenges. And I think we are seeing a falling apart of the social contract that is basic for this.
Let me go to Guillermo in Madrid. The Spanish economy has suffered a particularly bad fallout from two issues, a housing crash and a weak banking sector. Do you see any prospect that the policies of austerity narrowly defined are going to resolve these great structural problems of the Spanish economy?
No, I think the contrary. I think that now austerity that is imposed on Spain is going to get things worse because of the speed. It's a huge speed that is asked to the Spanish economy to reduce 5 points of GDP in 1 year. We have to remember that Spain was not a profligate country in the sense that we had a surplus of 2% in 2007 and as well as a 37% debt to GDP ratio. And we are doing everything, all the structural reforms, everything that is needed, and we see that growth is now negative and can be negative next year. And we forget something that you didn't talk about is that in Europe and in Spain even more, the banks are deleveraging and there is no credit growth. So if you have austerity plus no credit growth, even other countries like the Netherlands or France and so on will go into the same direction. That means to recession. If we establish only nominal measures, nominal deficits instead of structural deficits, we will go all into recession.
So let us be clear, you're not at all arguing against structural reform of the Spanish economy.
No, the contrary.
Indeed,
They are essential to counteract the austerity, but they take time. So if you match austerity increases with medium-term structural reforms that will create growth, then it's okay. But if you want austerity at the start, very big and very sudden, and expecting for growth in many years, negative multipliers will be very high, and you will get less revenue and more recession.
So austerity narrowly defined is undermining the progress of structural reform in Spain.
There's no doubt.
Thank you.
Going to create more rejection to everything that is done by the government.
Okay. Let me turn to George with reference to the plight of Greece. Do you think, George, it is remotely plausible that Greece's debt to GDP ratio will meet the targets of 120% specified for it under the bailout package? I know that great strides are being taken in that direction, but how plausible is that aim?
Well, the precondition for that is for growth to resume. Without growth resuming, that would be very hard to happen. And we are in the 5th year of recession. It is very clear that the recession started before the austerity started, because in 2009 we already were in a recession 3.2, and the deficit was 16%, the highest ever. But it is also clear that the austerity did contribute and deepened the recession. And I very much agree on this point with Guillermo that it is now hampering structural reforms. We have actually reduced our primary deficit by 8 percentage points in 2 years. This has never been done before. It is huge. We started off with a huge credibility problem, and we had to prove that we could actually do this, and we did it. However, it is very clear that as incomes are lower, tax collection, for example, becomes very hard. And reform of the tax system, cracking down on tax evasion, for example, compliance, it becomes very difficult in an environment where you have an ongoing recession and people's incomes are going down. So structural reforms that would actually help the economy medium term become increasingly more difficult as the recession deepens. On a political economy level, people lose faith that what you're doing is actually leading somewhere. They believe that there is no hope. And given that austerity usually, by necessity almost, can never be entirely fair because you have to take a number of horizontal measures, they also see this as a completely unfair process. So the combination of no prospect and lack of fairness is dynamite under what is a necessary restructuring of the Greek economy and society.
Thank you. The argument, trying to be devil's advocate as I am, the argument for really tough austerity measures along the lines that the opponents of this motion would prefer would be, I suppose, that it would work through the financial markets, that if really hardline austerity were not applied, then the cost of borrowing would shoot up perhaps even further than it has already, and that this would intensify Greece's debt burden. What's your reading of that critique?
Well, Greece is not typical in that respect, because our cost of borrowing is the official cost of borrowing, because we no longer borrow from the markets. We only borrow from our official partners. And in that sense, I think better placed would be other people to address your particular question. However, what we've seen is the exact opposite. But I think this has a lot to do also with the fact that what started off in Greece quickly became apparent that it is a systemic issue, and it goes much beyond Greece. And it was very clear that that the European countries acted in a firefighting approach, didn't have a plan, were late to develop a plan, and the plan that they developed isn't complete. At the moment, what is keeping recession as bad as it is that the banking system is completely dry. There is no finance even for healthy businesses. So you have a strangling of the system, both from the demand side, because incomes are down, wages have been cut in the public sector about 40%, and also from the supply side, in the sense that firms cannot find investment funds to even as working capital. So the combination of the two is absolutely deadly for the economy. And until something happens on a European level, and at the same time we get a more relaxed fiscal path, which is something that even the IMF is arguing for, then it's hard to see how the situation will improve.
Thanks very much. Emily, I'll summarise very quickly my line of the argument, drawing on my witnesses, on the witnesses' observations, by saying, again, that no one is disputing that governments over the course of a business cycle need to operate a balanced budget, but that's not remotely the position that we're in at the moment. Where we are at the moment is that certain economies, need to make important structural reforms to their labour markets, to their welfare states, to their tax collection systems, and a very harsh, hardline policy of austerity is making it much more difficult for them to implement those policies, with possibly very ugly political consequences.
Oliver Cam, thanks very much indeed. Now we have Martin van der Weer, the advocate against tonight's motion. So austerity is not the answer. Martin is going to disagree with that, and he's going to build the case, as we just heard, for fiscal discipline. Martin, like Oliver, you have 10 minutes at your disposal now to talk across your witnesses and cross-examine whoever you may choose.
Thank you. Well, let's stay with George Papakonstantinou, if I may. George, give us your idea of what will actually happen if, in the rerun of the Greek general election on the 17th of June, if the result is a sufficient swing to the socialist parties for them to form a coalition and to announce that they basically want to walk away from the bailout terms and, if necessary, default on their debts. But, of course, they also want to stay in the euro. I mean, what actually happens in those circumstances?
Well, I think your guess there is as good as mine. I would hope that our European partners will show sang-froid, let's say, and develop a dialogue with whichever government is in power, because that's a democratic process. I strongly believe that the position that some of the extreme left-wing parties have taken, which is that we can somehow stay within the Eurozone while unilaterally tearing up the agreement and even denouncing the debt is simply not something that will work. So a dialogue will engage, and we have been saying, and my party has been saying from the beginning that as I argued before, we need to make changes to the current agreement. We need a better fiscal path. We need more liquidity into the system. We need more time for the structural reforms. However, we are here in danger because we have pushed so much, so fast, that the extremes have gained acceptability, and people are fed up. And when people are fed up, they vote for people who offer the easy answers. Unfortunately, there are no easy answers. And this is where we're at.
Do you think an exit from the euro is a real possibility, or is that something that we in the British media especially, but media far from Greece, as it were, are talking about much more than people in Greece are talking about it?
I think that that's very true. Well, everybody's talking about it. There's no question about it. And what used to be a complete taboo is now on the table. I think people who argue for it greatly underestimate the negative impacts both on Greece and on the Western Europe through contagion effects. I don't believe there are such things as adequate walls to contain contagion. On the same time, the feeling that Greece is sliding outside the euro can have very quick negative effects for the country in terms of the banking system, the deposit flight, which we already have. Therefore, you don't need to have a decision for Greece to exit the euro, but you can find yourself in a situation where you have to take those kind of very difficult decisions because you have run out of cash and because at the same time your banking system isn't functioning properly.
Which is worse? Which is more painful for the Greek people, to stay in, bear the austerity measures that are currently in the bailout terms, as it were, or to take the cataclysmic consequences of coming out of the euro? Is that an even worse option?
Without question. Yesterday, there's a report that came out from by the biggest Greek bank, and their analysis suggests that exiting the euro, even if it's in an orderly fashion, which to my mind is a contradiction in terms, would lead to an additional reduction in GDP of over 20%. Inflation would go to 30%. Unemployment would go from 20 now to 30 or 40%. And living standards would halve. So that's not an alternative that I would want for my country.
So in that sense, austerity is a less worse option. But let me ask Yanis Varoufakis, if I may. I believe that you have argued for walking away from the bailout terms, but also that Europe will simply have to keep Greece in the euro for fear of something worse. And I think you wrote in the piece that I read that you weren't saying Greece was therefore going to blackmail Europe into giving it easier terms, but actually, the way I read it, that's exactly what you were saying. What's your response to that?
This is precisely what I was not saying, but let me try to focus on also answering your question, but also on the motion that we're debating. Look, like you, I also believe that austerity can work, but there are two prerequisites for it to work. Firstly, we must have a situation where your trading partners are growing while your own country or bloc is imposing austerity upon itself, like Canada did in the mid-1990s. A second alternative would be to have fiscal austerity while some kind of bubble is building up, either in real estate or in finance, like in Britain in the 1980s. But neither of these now apply. Now, look, the other distinction I want to make is between what's happening, for instance, in the UK, where I think that the Cameron government has simply miscalculated and has put all its eggs in the basket of expansionary contraction, which is simply not working. But that, at least, is not threatening the very fabric of the British society. It's imposing, I think, unnecessary costs on the British society, but at least Britain is not threatened as an entity. In Europe, what we have at the moment, and I think that this is not hard to see, just observe what's happening in Spain today. You have insolvent banks being bailed out by insolvent states, And this resembles a death dance of two weak swimmers clinging onto each other, sinking very fast towards the bottom. What is happening in Europe? There is no austerity in Europe. What we had Ponzi growth prior to the crisis in 2008, and now we have Ponzi austerity. Because if you look at the sums that are being talked about...
Do you want to just explain that, but briefly? What do you mean by that?
Well, we had Ponzi growth because in my country, for instance, in Spain, in Ireland, we simply had, as a result of the way that the Eurozone was created, a huge influx of capital in search of higher returns in riskier investments in real estate, in Ireland, in the public sector of Greece, and so on and so forth. Bubbles were formed. That was a Ponzi growth. And now we have Ponzi austerity because we have huge quantities of money being printed and being generated in the form of bailout loans, LTRO by the ECB, and so on and so forth. But all that largesse, and we're talking about largesse, is combined with the incredible sight of one member state of the Eurozone after the other being marched off the cliff of competitive austerity. Because when you have, as we heard before, I'm not going to say something new, when you have all these bailout funds being utilized in order to pretend, to carry on the pretense that you can deal with a cascade of insolvencies as if they are problems of illiquidity, then you're simply throwing good money after bad, while every member state is being marched off the cliff of competitive austerity.
Okay,
So
I need to...
Let me just answer your question very briefly.
Okay, that'd be good, yeah.
That we need a circuit breaker in the Eurozone. Something has to stop this madness in action. And a Greek no to bailout terms which cannot be kept even if God and his angels descended upon Athens, formed a government and tried to implement them, that no is the prerequisite for saving the Eurozone.
Okay, now I'm going to bring in Matthew Lynn, columnist for the Wall Street Journal and also the author of a book about the Greek crisis, which came out I think 18 months ago and was called Bust, simple and vivid title, and I think which pretty much predicted everything that's happened since. Matthew, what's your take on what you've heard so far?
Well, it's an interesting debate, but I think it's a little hard to tell precisely what the dividing line in this discussion is. But as far as I see it, it seems to be the idea that there's a sort of another path out there. The problem in the Eurozone is the euro. It's not austerity. The problem in the Eurozone is that you have a currency which was an interesting idea and an interesting experiment, but which has quite clearly failed and become completely dysfunctional and produced a huge range of problems. And this idea, which seems to have kind of gathered steam and is getting some traction here tonight, and it's getting a lot of kind of talk out there in the rest of the world, that there's a third path of the Eurozone. That if you just had a bit less austerity, if they just spent some more money, took on some more debt, printed some more money, that would fix the crisis. That's not going to happen. The crisis would carry on. I mean, go back a few years, and actually part of the problem in the Eurozone was that it was too expansionary. If you look what happened in countries like Spain, what happened in countries like Ireland, also countries like Greece, there was too much money, there was too much debt being taken on. Our colleague in Spain, Janoma, was saying a little earlier, Spain was a responsible country. Well, that's true of the government. The government didn't run big deficits, but Spain was a very profligate society. In 2006, 2007, Spanish trade deficit was 10%. So this is a country that was consuming 10% more than it produced every year. And the idea that if you just kind of relaxed on that, went back to that, spent more money, printed more money, you'd fix the Eurozone crisis is untrue. You just carry on with the same problems. You might postpone, you might buy yourself another year, another 18 months, but that's the best you could hope for.
Yeah, and whilst economic theory is a large element of this, market sentiment is the other very large element of this. So before my time expires, can I just ask Julian Callow, economist from Barclays, for a comment also. If there is a general shift away from the previous consensus in favour of measures of austerity, of fiscal discipline, how are markets going to take that, Julian?
Well, I think the question is really how you are going to pay for the remaining deficits. The austerity is being intended here to combat the fiscal deficits, which are still very substantial in many countries. For example, for Spain, I think we will see a deficit for the government sector around 6% of GDP for this year. For Greece, last year, the budget deficit was running at 9% of GDP. The question is, who is going to pay for these countries to continue borrowing. And that is linked in very much to the next point, which is really debt is way too high based on historic evidence for many countries. Right now, we're dealing with ratios of debt to GDP, which historically we've only seen in times of war. And so we're dealing with a very aging society here with relatively weak productivity growth and not really any significant intrinsic growth in the population. And for quite a few of these countries, public debt GDP ratios are running at over 100%, which, as I say, is very rare historically. And in other countries, they're rapidly climbing. And the markets have really, I think, lost confidence here in government's ability to run sustainable fiscal positions. And that is really why the markets themselves have been, I think, arguing for austerity on the fiscal side alongside structural reforms. But also from the market perspective, it's not just fiscal policy that matters. The other side of things is what other policies can you have, monetary policy, other policies that can actually create stronger growth in Europe and elsewhere that can actually counteract some of the fiscal consolidation.
Thank you very much. So there we are. In one sentence, I am simply arguing for sound government, for fiscal discipline, something we actually haven't had for many years in most of these countries. That's not the most extraordinary thing to be arguing for, Emily.
Martin van der Weyer, thanks for drawing that section to a close now. We now enter a slightly more freewheeling point in the debate. Voices from the panel and from the audience through Jemima can join this. And we've had some very interesting points raised. We've asked whether austerity is a less worse option for Greece than exiting the euro, which might come as a result of a lack of austerity. We've also had quite a key point from George Papakonstantinou, and I want to put this to Anton LaGuardia, the economist who joins us from Brussels. You heard George say it's politically a very difficult argument to sell this. It leads people to think there is no hope. Now, given what we've seen with Hollande, if you like, a sort of European, change you can believe in, do you think that this has changed the dynamic, changed the rhetoric now in European politics? Anton?
I think the election of Hollande has changed it at the margins, in that you now have European leaders falling over each other to talk about growth. Of course, they all disagree as to what growth really means. If you're German, it means fiscal discipline is the essential foundation for growth. If you're perhaps French or a Southerner, you'd say investment and public spending will lead to greater growth. If you're British, one of the Nordic liberals, you'll say deepening the single market is about growth. So there's a fundamental disagreement as to what growth means. What will emerge is a little bit of extra money on the investment side. They'll put a bit more money into the ECB. They might rejig some of the EU regional budgets. But that is not what is going to change things. I think one of the interesting things you heard tonight from George Papakonstantinou is the fact that there are no easy solutions. And in fact, I don't think we've really heard from anybody a coherent alternative plan to what is going on. Really, the debate is about a bit more austerity, a bit less austerity. Nobody's pretending that countries that are under pressure from the markets, remember Mr. Bond with his gun, he's holding a bond spread. And a number of countries had no choice but to start reducing their deficits. By the same token, it is clear that in the case of Greece and possibly of Spain, that austerity has gone too far. That people have discovered the multiplier. The multiplier is actually much bigger in the context of a country that is in recession. So therefore, the real question, and you see this in the IMF papers, is how do you mix a bit of austerity, a bit of growth? And I think it is the one point that is important here is that you're in a context of extreme lack of confidence about the future of the euro. And I think that is sapping any will to invest, any hope that this is going to get better. And the circuit breaker that you heard Yanis talking about is possibly one of two things, which both involve greater burden sharing and greater integration. One is banking union, where you Europeanize the way of bailing out banks so that it doesn't fall on the shoulders of the other weak swimmer. It falls on the shoulders of everybody in Europe. and the other solution is perhaps Eurobonds, where everybody pools their debt. The problem with that, the economic logic leads you to that. The problem with that is that you run into the political economy of the creditor states, not just of the debtor states, who don't want to stake more billions on an uncertain result in Greece and in Italy and Spain, and whose voters are increasingly skeptical. They don't want more Europe. If anything, they want less Europe.
Let me bring some of the austerity voices back in on that note, that you are creating, Matthew or Martin, the downward spiral, whereby you not only lose that hope, but you lose the ability to actually generate the growth for the country itself.
Well, let's mention here Ireland and Italy, for example, where, again, until this debate opened up in the way it has done just recently, on the whole, the impression was that the austerity measures were working sensibly and were meeting a reasonable degree of public support. So this is, as I tried to indicate, the emotional level of this has suddenly been cranked up, as though the whole thing is a disaster, the whole thing is deeply opposed all the way across Europe. I think, in response to Anton's remarks, what I'd like to ask him is, so what happens if Germany just isn't prepared to fund all of this, that all of these softer solutions, as it were, depend on Germany underwriting the debts, the new issues of debt, the bonds for projects, the Euro bonds themselves. If German politics don't allow that to happen, then what happens next?
Ian. Can we just before we go back to Anton, if I bring Ian in, is there a viable alternative here?
Absolutely. I think all of us agree that there has to be, over a business cycle, some austerity. The question is the speed, and Guillermo has indicated that the death knell for Spain is the pace of austerity. George, from his experience as Minister of Finance in Greece, has indicated that it was impossible to implement in his time. So austerity is going about it much too fast, and the motion again is that it is not the only answer. What we have to see the other ways. Fiscal pacts, for example, the Maastricht Treaty very clearly set debt limits. It very clearly provided the anchor for a successful euro. It wasn't held to. So what we clearly need in Europe is fiscal laws that stick, and we need statistics that are inspected. We need a strong Brussels that is able to ensure that the rules are obeyed, and one clearly can't be in the euro if you're not going to obey the rules. But that is a different path to the one being adopted through pure austerity measures.
I'm going to go back to George Papakonstantinou in a moment, but Eric, you wanted to come in on that point.
No, I think it's very important to understand that in Greece, if we don't get new capital into Greece, it's not going to work. So we need capital. We need capital that comes with governance, with strong discipline. We need capital that brings in other private capital. I think this is that was just mentioned, that there are some ideas now around how one could do this, and letting the European Investment Bank, for example, channel some of this money is very important. And to get these solutions to the overall banking crisis is also critical if we want to find a solution.
I'm just going to bring George Papakonstantinou, if you can join us in on this one. How spooked do you think Germany actually is by the kind of politics we're seeing going on in Greece at the moment? And we saw the leader of the Syriza party in Berlin, 10 days ago, saying that it was fine, that actually Greece could stay in the euro without austerity, no problem. How seriously are they taking this now?
Well, I think that they're probably taking it with a grain of salt. But can I go back to the word emotional, because it hit a nerve listening to it. You can talk about emotions, but you have 1 in 2 young people being unemployed in this country. But that is emotional. We have people working in the public sector that had a 40% nominal wage cut. That is very emotional. So, let's get real. There is a point beyond which the real situation is such that, it leads to extreme political choices. And I understand completely the other side also. I see that there is a populist debate in Germany, and I see a German, Finnish, Dutch government trying to convince their own people to keep lending to a country. And I see too many stereotypes flying around. So we somehow need to get the debate back on a rational basis.
What are you talking about?
That, you know, that the country is unreformable, that Greeks are not working hard enough. Actually, you know, the OECD statistics say we work harder than the average European and much more than some of these countries. But, you know, stereotypes are very easy. And if we allow the debate to be hijacked by populists on either side, then we're doomed. Because then we will get to Matthew's point, with which I profoundly disagree, which is that, you know, to believe that the euro is a problem. No, we knew from the very beginning that the euro construction, as was originally conceived, was an incomplete construction. Now is the time to complete that architecture.
Martin, Matthew, sorry, I'll let you come back on that one.
Yeah, I just want to come back on that point, and also the point that the last couple of speakers have been made, that you can have, you know, you can have euro bonds and you can have a sort of common fiscal government within the eurozone, and that would somehow work better. And the problem really is, you know, which countries benefit and which countries lose. So if you take the example of the UK, for example, or the United States, you know, you can have the central bank can print money and the government can, you know, run a bigger fiscal deficit, and there are kind of costs and benefits to this. You know, you get maybe low unemployment, you get a bit of a boost of demand, you might get higher inflation down the road, you might have you might have a lower currency, but they're all within the same country. So like in the UK, we can say, okay, the Bank of England prints money, we can have a debate about that. And there are costs and benefits, but the costs and benefits are all experienced by the same people. And the problem within the eurozone is that the costs and benefits are experienced by the different people. So if you start printing money, a common fiscal policy and euro bonds, basically the costs are all borne by the Germans and a bit by the Dutch and a bit by the Finns, and the benefits all go to the Spanish and the Italians and the Greeks. And that's not a sustainable situation because it's not a common political culture. And so at the end of the day, and quite quickly, probably not at the end of the day, probably at the beginning of the day, the Germans are going to jump up and down and say, we're not going to do it.
We're going to go to Jemima in a moment to hear what viewers, those watching have been making of this. But first, I just want to go to Guillermo de la Dehesa in Madrid once more. This idea, basically, of the euro as a failed theory. This is not something that was ever destined to work properly. That's at the root of this.
Yes, it is true that the euro has huge failures in its design, that we all, at the CPR, we produced 3 or 4 books explaining the failures for the future in the euro. But there, I think that adding to that, we have had also a very extremely bad management of this recession and this crisis. Very bad management. So there are design failures and management, both. And so we have to start doing the things properly.
Okay.
And we not yet.
We're losing the sound on you for the moment. Ian, I'll bring you in briefly if you've got a point of disagreement with that.
I want to strongly disagree with Matthew's idea that somehow the benefits have gone to Southern Europe and the costs to Northern Europe. Last time I looked, Germany was doing extremely well. Exports amongst the records ever. Growth stable, unemployment extremely low. That's because it's in the euro. If it left the euro and had some sort of new D-mark, see what would happen to the German economy. The idea that somehow the Germans are the losers is the biggest myth in this. Northern Europe has been a primary beneficiary of the euro, and I think the whole of Europe appreciates that. And that's why they'll stay.
We're nearly at our halfway point. One line from you.
Just actually, the ordinary German companies have benefited by running a huge trade surplus and huge profits. It's great. It's great. No. Look at German retail sales and look at German wages since the euro was launched. German wages and German retail sales have been absolutely flat. The average German does not benefit from having an overvalued currency.
Okay, let's go to...
overvalued? It's undervalued for Germany. You've
Let's
got the wrong way around.
I'm going to take you to Jemima first of all, and just if you can tell us, Jemima, what people are making of the debate so far. What are the phrases that have really stuck out there, have been picked up on?
Well, as expected, Emily, there's plenty of outraged Greeks commenting online. There's no real consensus. There's a majority. The earlier vote reflected that most people are anti-austerity, but there's very strong feelings on the other side of the debate as well. We've got a question here from Graham Standing via Google+. Which side is history on? Has austerity worked before? And what are the examples? And other questions like that, looking at examples from around the world and from history. We've got a question from Kieran Thompson via YouTube. Why does Japan have the highest debt to GDP ratio, yet the lowest borrowing rates? And then an ethical question from the very prolific and fairly angry Chris Warner, which is, how can we justify borrowing money for ourselves and forcing our children to repay it?
Jemima, thanks very much indeed. We are at that halfway point, and as I mentioned at the beginning, we asked you to vote. We've now got the results of the vote as it stood at the beginning, okay? So this is how you voted before you heard any of the arguments, before you heard any of our speakers begin. And this is the motion. Let me remind you once more. Austerity is not the answer. 76% of you voted in favour of that. Austerity is not the answer. 4% were against. And there were, take heart, your austerity is 20% don't knows. Now, let me reinforce, it may feel like a tough mountain to climb for the austerities. Well, let's hope it can only get better. There are 20% of voters out there who have not made up their minds. We may not see a landslide, but we can certainly measure what kind of impact your argument is having during the next 45 minutes. So that's how things stand now. Everything still to play for in the second half of the debate, and we're going to return to the witness examination. It's now your turn, Martin, to start questioning your witnesses, and you can broaden this out.
Okay, thank you very much. Well, thank you very much to the 4% that are with us so far. How wise you are.
It might not be now. That was 45 minutes ago.
Now let me bring in the witness who hasn't been invited to speak yet, Eric Jones of Oxford Analytica, and try and get an answer to my question about Germany. Well, we had a little knockabout about Germany there. One reason the German economy is as strong as it is of course because Germany got its austerity in first, as it were. It went through a period of quite painful reforms pretty much a decade ago and put itself in very competitive shape. And German voters are not keen to give away the advantages that they've gained, even though we can all agree they have profited from the euro. They may have even profited from the troubles of the weaker euro members, all of that. But Eric Jones, what's your view about what happens if Germany simply won't stand behind Eurobonds or borrowing through the EIB or all these other soft mechanisms, as it were, that are being suggested as the alternative to austerity?
Well, Martin, thanks for bringing me in. The view I have is that Germany right now would have a very difficult political battle to support any of the measures that you suggest. I just came back from Frankfurt, and in Frankfurt, the overwhelming opinion is that the Germans have already been excessively generous with the Greeks and with the other countries of the Eurozone, and they're unwilling to walk back on that. Certainly, there is a passionate debate about introducing Eurobonds. There are some strong voices in Germany in favor, but the overwhelming volume of public opinion is against. I think that's unfortunate. I'm not part of the 4% that support your case. And I think that the German people actually have a very strong interest in coming around to a very different view of the crisis. The difficulty is that the view in Germany is dominated by newspapers that are determined to use the types of stereotypes that George described in order to put emotion into the debate and presumably sell newspapers as a consequence.
So what should we... On the assumption we can't do anything about newspapers, as it were, the German opinion is likely to harden rather than soften on this, isn't it? I mean, as Mrs. Merkel approaches an election next year, this is going to get even hotter as a debate in Germany, isn't it? So the prospects of agreeing on Eurobonds and so on is actually receding. It's not getting any closer.
I think you're absolutely right. And the danger is that as we continue to muddle through, something really terrible is going to happen that will shock German public opinion into a reconsideration of these issues. I mean, that's something terrible. Could be a situation in Greece with the Greek banking system. It could be a situation in Spain with the Spanish banking system. We have to make sure that these things remain on life support in the meantime. And unfortunately, as we know, the markets can turn against them very quickly. When there is a reconsideration in Germany, and I certainly hope there will be, then we'll have to come up with some solution that's amenable to the Germans. And there, I think that the points that Matthew has made about the perception that Germany is not benefiting and the other countries are benefiting is what we have to wrestle with. One of the things I asked while I was in Germany is, as a German taxpayer, how do you feel about paying taxes when your government can borrow at 0%? Is there no investment that the German government can make that has a positive real rate of return that would warrant going into debt?
Good question.
Right. Sorry, did you finish that? You stopped?
Yeah, I got a weird scream.
Oh, okay. Okay.
So, but I can stop there. That's fine.
All right. Well, so let me put this to Ian or Eric Bergloff here. So with the difficulty of getting Germany on board with the sort of solutions that I think you see as being necessary as the alternative to austerity. So what's the way forward? What mechanisms are actually available in the real world?
Yeah, I mean, let's first get the facts right about German history. Germany,
well, not too much history. Let's answer the question.
Germany did not do massive austerity. It did massive fiscal stimulus and growth. Part of the process was to absorb Eastern Germany into it, and as a result is a very, very good spirit. That means that German debt now is much higher than Spain's. German debt is 87% consolidated of GDP. Spain's is 74%. Crises, there's not some magic debt number like you slip off the cliff. It's the markets, it's the commentators, and it's others that determine what this is. And what the German story on debt is certainly is they built up massive debt, partly to finance Eastern European integration. The currency for Germany is undervalued, not overvalued, as Matthew says. In other words, if Germany left the EU, its currency would appreciate. That is very good for German export, but also for the German economy. The idea that somehow most people in Germany haven't benefited from the euro, I think, is not factual. Okay, where will it go? I think it requires politicians in the leadership in Germany, and I won't comment which party they'll come from, that talk it like it is. In other words, they have to explain how beneficial the euro and Europe is to Germans and what the cost is. And the cost is, I'm afraid, going to be a long walk to exiting the crisis we're in. But it's a long walk where austerity is one. Why can't you have
the German people?
Why can't you have leaders that tell the truth?
Wait, let's see. I mean, if we had to be guided by German public opinion, none of the things that have happened since the crisis broke out would have happened. And we have actually moved quite a bit in establishing something that is a credible addition to the rest of the euro. We have something of a fiscal compact, which would not probably have happened had we just listened to the German public. It's about leadership, and then that's leadership, I think, is there, and there is a willingness to lead Europe as Germany has done in the past.
Martin, you've got 5 minutes to make your arguments. You're in control of this session, so go to the people who will support you and boost that 4%.
Okay, well, I want to pick up on Guillermo's remark there about huge failures in the design of the euro. And I think he was saying, but we can sort this out, we can tinker with the design. And I think George was saying something similar, that this is the opportunity. Rather than being a disaster, it's an opportunity, or at least it's an opportunity for a fresh disaster, if you see what I mean, to move to the final construction of the euro. Well, let me bring Matthew in on that. Do you think there's any realistic sense in that, Matthew?
You know, I mean, I don't think there is. I mean, in this country, the debate on the euro tends to be very, very ideological, and people have very, very hard positions on either side, and it tends to be mixed up with how people feel about a single European government. I'm much more pragmatic about it. I mean, the euro, when it was launched, you have to recognise this was an experiment. No one had ever tried putting together a monetary union on that scale between 17 different countries. And I think if you stand back and look at the evidence after 10 years, you have to conclude that it's not working. I mean, in some senses, the euro is already gone. You know, it's a kind of dead parrot. I mean, one of the measures measures of what a single currency is that you have a single cost of capital throughout that. That money has the same price. The price of money is the interest rate. Well, that's completely gone within Europe. I mean, you have whole countries within the Eurozone which no longer have a private capital market. Greece can't borrow money anywhere except for a bailout package. In Spain, money now costs 6.5% as opposed to 1.5% in Germany. So I think you have to step back and say, step back from this crisis and say, actually, that was an interesting experiment. There were some good arguments in favour of it. There were some interesting arguments about deeper capital markets and integrating single markets and all that kind of stuff, having freer trade. All quite good and quite sensible. But this prolonged crisis after 2 years, I think any sensible person has to say, hey, that's a little dysfunctional.
George, you talked about this being the opportunity to take the euro to its final stage, as it were. Just describe to us what that final stage of building the euro actually is.
Well, I think you need a number of elements. Clearly, you need some kind of a fiscal compact. You need probably debt breaks in countries, even though that is how exactly they are imposed can be discussed. You need some kind of mutualization of debt. And that's the counterparty to having a fiscal compact that everybody adheres to.
What do you mean by neutralization? I'm sorry? Mutual, sorry. Okay.
Mutualization of debt. So you need something akin to Eurobonds. And I disagree with the position that they are further away now than they were some time ago. I think that, if anything, even within Germany, what was an absolute no-no is actually being discussed in terms of, yes, under certain conditions. And I think that's a big step forward.
Okay.
And you may need what I think Eric Bergloff suggested, which is some kind of a banking, no, that was Anton, I think, some kind of a banking union as well. Yeah. Clearly, this is a difficult thing.
Let's stop there, because I think I'm
1 minute, Martin.
I'm out of time. But
you got 1 minute. You got 1 minute.
Okay. Well, if I had to sum that up so far, then it's that the alternative to austerity, to sound government, to fiscal discipline and responsibility, is to hope the Germans are going to underwrite the whole structure and to blunder on with a currency that was ill-conceived and ill-designed and seriously ill-managed, as Guillermo said, so far, in the hope that the German taxpayers are prepared to take the ultimate pain for that. But actually, they're not prepared to take that pain, so this is a kind of false argument.
Okay, Oliver Cam, over to you. This is all based, the alternative is all based on something that the Germans might prefer not to do.
I think that the reading of the German political scene, particularly that Eric has given us, is quite accurate. And I'm particularly concerned with what was referred to as the debate being hijacked by populists on each side. But I do want to stress that while all of us can agree that there were design flaws in the creation of the euro, and I'm a Europhile and I would accept that the lack of a fiscal dimension to the euro was a crucial weakness, nonetheless, it is quite absurd to suggest that Germans have not benefited from the euro. And I'm slightly surprised that Matthew thinks that Germany has an overvalued currency. What do you think, Ian, of the position that Germans are in within this crisis? What stake do they have in resolving it with bailout packages to highly indebted economies?
Germany has a massive stake. In fact, it probably has the biggest stake because it's been the biggest beneficiary of the euro. Its exports to Europe, its integrated economy, its workers that have come to it through Schengen and other agreements have all been absolutely fundamental, as has the whole political project of the reunification of Europe. That is where Germany is central. The costs it's paying, and it has built up costs, are very small compared to the benefits. A free-riding Germany outside would be politically weak. It wouldn't have a voice on the international stage, rather than being very strong within the European stage and therefore globally, and it would be economically weak. But I do also want to suggest that I think this focus on Europe as a test of austerity is wrong for two reasons. First, Europe is not a pure case of austerity. Most of the European leaders are not saying austerity is the answer. We've just had an election in France where all the political candidates, all of them, said austerity is not the answer. Secondly, Europe is not the only place in the world where austerity has been practiced in the past and is being practiced. So I think we need to look at the US, we need to look at the Japanese experience, as one of the people that have written and have said, and ask ourselves what's happening there. And the answer in all of them is that austerity is not the answer. The US is not trying to practice only austerity. It's going way beyond it, although its debt levels are 20-30% higher than those in Spain.
Let's pick up on that point of the US. Eric, why do you think the US recovery has been so much stronger, US economic performance has been so much stronger than, let us say, the UK, now in a double-dip recession?
Well, I think the US clearly, at the outset of this crisis, tried to do something like a fiscal spending to stimulate growth. I think where Europe is, of course, different is that we don't have the same instruments. We don't have the instruments of devaluing and stimulating exports like the UK has done. So I think the options are not the same.
Okay. Over to you. This is your time, Oliver, so you can build your argument using the witnesses that best serve you.
Well, let me go to Eric Jones. Let's suppose that Germany fell prey to very populist pressures in politics and in an extreme case decided it didn't want to stump up taxpayers' money and it left the euro. What effect do you think that would have on its own economic performance? What would happen to a reintroduced Deutsche Mark?
Well, I think a reintroduced Deutschmark would appreciate dramatically, and the consequences for German exports would be similarly dramatic. I mean, there was a question that was raised earlier about the decline in German labor costs during the euro. I think what wasn't pointed out is that after German unification, Germany lost a huge amount of competitiveness, and its relative labor costs and its real effective exchange rate appreciated secularly until about 2000, 2001. So what we've seen during the course of the euro is a correction for that unification shock. And Germany has only just recovered its competitiveness, the competitiveness that it had prior to unification in the early 1990s. If we take Germany out of the euro, it's going to go back into another negative shock again. And I think the consequences, not just for German industry, but let's not forget, the German financial system is hugely exposed to its partner countries. So German finances would be in dire shape as well.
Okay, thank you. George, let me turn to you. I'm going to come back to this question of a hypothetical exit of Greece from the euro. You quoted some figures earlier, and I think I took them down correctly. You suggested that living standards would halve. What do you think would happen to, do you think there would be a contagion effect across southern Europe in conditions of such extreme austerity? I mean, is this even a plausible scenario at all, that a democracy can continue with a policy like that?
I think that if Greece were pushed in that direction and if there was an accident, I think that the impact on the Greek society would be tremendous. And I frankly do not want to even start painting the picture that would emerge. I think that as far as Europe is concerned, I think we saw very clearly in some wrong decisions in the recent past how contagion can happen very quickly. And here I refer to the famous end of the 2010 Deauville decision between France and Germany. To remind us all, this was a decision that in 2013, those countries whose debt was unsustainable would then have to be restructured, the debt, and private bondholders would be the last ones to take the money out. That immediately stopped in its tracks any success of the first Greek bailout, where spreads were falling, and for a very simple reason. Why would anyone want to buy Greek, Portuguese, Irish, Spanish bonds when they knew that there was a possibility of losing the money 2 years down the road? So the contagion effect will be immediate. And there is, I do not see that there is the stomach or the capacity in European institutions such as the FSF or the ECB to be able to stop it. And this is why this is what makes this all the more dangerous. And this is why there have to be reassuring noises, such as the Growth Pact, such as the willingness of the ECB to continue to be lending to Greece until we have this political situation sorted out and then a new agreement is agreed, and a fiscal path which makes more sense.
Okay.
Oliver, you've got 2 more minutes.
I'll ask Ian very, very briefly before I summarise in 1 minute. Can you tell me in 1 minute, Ian, are there countries that have operated successfully this expansionary fiscal contraction?
Yeah, most of the developing countries, emerging markets are doing it now. I mean, Brazil is a great example, and there are many, many others. They've learnt the lessons of the debt crises of the 70s, 80s, and 90s. They understand that they have to manage over a cycle their macro, that you can have debt to GDP ratios that are bigger than the current numbers, but you've got to have a credible plan for reducing them. And you do that by demonstrating how you're going to grow over time. That means investing in education, investing in infrastructure, ensuring that the poorest are lifted out of poverty. That's what emerging markets are doing. It's quite amazing to me that we preach and praise them around that, and we are unable to digest the lessons for ourselves.
I think in summary, there is, and I blame particularly the industry that Martin and I come from, the media, I think there is a temptation to assume, certainly in the Anglophile media, that the Europeans don't quite know how to manage their own affairs. All of us would agree that there were design flaws to the euro, but austerity on the model that is being advocated by the opposition to this motion is simply going to undermine European cohesion, European growth prospects, and damage living standards. Perhaps that is the intention behind it.
OK, so that's where we are just a few minutes before we end. On the one hand, we've got those saying austerity is not the answer, saying, yes, there were design flaws to the euro, but austerity will only undermine what is already a pretty grave problem. On the other, you have a very clear voice saying austerity may be tricky, but the alternative, if you can even imagine Greece leaving the euro, is much, much worse. We've got about 12 minutes to go a bit more widely with this debate and bring in some of those who've been watching online. We'll go across to Jemima. What kind of questions are coming through for our panellists, or just being raised where you are, Jemima?
Huge negativity and scepticism about the euro. A particular question is, the euro is crashing and bringing the United Kingdom down with it. My point is, why are you talking about trying to save a dying currency? And that seems to be a sort of general feeling, although that's from G.G. Allen on the Google Plus page.
Why don't you just hold that point now, and we'll go straight to Guillermo Della Dehesa for a reaction to that. Why are we bothering but trying to keep afloat something that, well, Matthew just called a dead parrot? Guillermo?
Yes, I was off for a while. So what was the issue?
It's a very stark quote. The euro is a dead parrot. Why do we even bother trying to pretend it is a viable currency or it's a plan that worked?
Well, I fully disagree with that mention. The issue is the following, is that the euro is going to survive because we need to fix the failures of its design. And it will take some time, but I am quite optimistic for two reasons. One is the country that has more to lose if it gets out of the European Monetary Union is Germany. Okay. Germany has been living for 2 decades of the internal demand of the rest of the European Euro area members. And they have been living on exports exclusively. The internal demand of Germany has been flat for 2 decades. And now we need Germany to grow and its internal demand to grow. Okay. If not, we are going to reduce our imbalances.
That's a very interesting point, and we'll go back to more questions from Jemima in a second. Let me bring in Yanis Varoufakis. You famously left. You famously left when you felt unable to offer advice on a bailout that you didn't agree with, Yanis. Could you imagine yourself negotiating a future package of some kind with the Troika?
No, I don't think that I'm the right person to be doing this. But if I were put in that position, I would simply say something very, very simple to the Troika. Give me, outline for me, some rational plan that might work. Not just for Greece, but also for Ireland, Portugal, Spain, and so on and so forth. Until and unless you can do that, then you can't expect my country to be receiving more money from the bailout loans, which are just a complete affront on rationality. Think about it. 2 weeks ago, Greece borrowed 4.2 billion from the EFSF, one arm of the European Union, in order to give it to the ECB. This is the insolvent Greek state borrowing all this money to give to one branch of Europe, taking from the other. Now, this is utterly unsustainable. If you look at what's happening in Spain today, you will realize that. But let me just, if I may, just one very, very quick point. There are two kinds of Austerians in Europe, those separated by the British Channel. German Austerians are all about using austerity in order to keep the euro. They are deluded, but this is what their objective is. British Austerians on your panel, on the other side of this argument, are all about justifying the fact that they were against the euro and sneakily utilizing this discussion about austerity in order effectively to effect a collapse of the eurozone.
You can't call somebody sneaky without me giving them a right to respond. So, Martin, very briefly, go on.
But the counter to that is that on the anti-austerity side of this, there is a fundamentally socialist agenda. There is a push, instead of favouring private sector competitiveness as one way to at least start moving back towards growth, the idea is to strengthen the power of the state in all these countries. So let's not pretend that there isn't ideology on all sides of this argument.
Okay, I'm going to go back to Jemima now. Sorry, Yanis, I'm just going to go back to Jemima because she had a few more questions, and it's quite interesting to see what people are concerned about as they watch. Jemima.
Yes, also some discussion about the social ramifications of austerity measures. For example, we have got Leon Eleftheriadis, who sounds like he might be Greek, via YouTube. There are fears of austerity causing a brain drain in Greece. What will be the effect of young adults leaving the country? And then another question, which is from David Foster's, via Google+. Isn't there a risk austerity will foster political extremism? For example, the rise of neo-Nazi parties in Greece.
I'm going to come back to the brain drain in a second, but let me bring Eric Bergloff in here. We have seen austerity in operation in places in Eastern Europe. We've seen what it does to the far right in Hungary, where it's become very vocal and very strong.
No, absolutely, and I think we should look at those examples. And there, in what's happened in Hungary, I think it's not only about austerity; it's about a lot of things. But it's certainly the measures that were undertaken stimulated a right-wing government and a government that also had, or at least support from even extreme right-wing party with also anti-Semitic party and so on. So I think we have to be very careful of the consequences of extreme austerity.
But could that have happened anyway, without the blanket cover of a word like austerity? When people are in economic trouble, they go to the extreme.
I agree with that, and I said that this is one aspect of it. But I think this is something that we have to be very careful with. And there is actually a lot of evidence. Some research have shown that these austerity packages lead to extremist parties benefiting.
Do you want to come in on this point?
Well, I want to come in on Martin's extraordinary statement that somehow anyone that doesn't believe that austerity is the answer is a socialist. That means the US government's socialist. Many of the European governments are, including Sarkozy being a socialist. I think he'd be amazed. What we're saying is that governments need to be able to give capital partly to finance private business. Ask the businesses in the UK. Ask the small businesses. Ask people that are wanting to get educated. Ask the unemployed if that means they're socialist because they believe austerity is wrong. I think that really is an extremist view.
The point was that ideology can fit whichever side of the Euro debate you're on. We've seen that in both ways. Let me just go to George Papakonstantinou. This idea of the brain drain. And we saw an amazing figure. Nearly 24,000 people left Greece to go to Germany in the last year alone, 90% up on the year before. George, I guess you must feel this in the country that you call home.
Well, we certainly do. You have extremely competent young people with 1 or 2 degrees. You have doctors, engineers who are looking for a better life elsewhere. Again, it comes back to my point of no prospect. And we all agree that, you know, a country such as Greece needs to be running a primary surplus. We need to be spending less than we have as revenue. And we need to make a lot of structural reforms in our pension system, our labor market, make it easier for people to create jobs and to invest and to create businesses. However, the way you do it, and if you just strangle the economy in doing so, then you simply lead people to believe that there is no hope. So they leave the country. And that undermines the growth prospects of the country.
Okay, and do you tie that to the austerity motion one way or another? If there were less stringent measures on these young people, would they stay, or would they say the economy's desperate, but there's no future for us anyway?
I think if it was clear that the austerity has an end in sight, that it is more manageable, and that people's incomes were not falling as fast and as much, then yes, you would have fewer people leaving. There is no question about that.
Julian Callow, to you for a perspective on the markets. It's been said that whatever happens in real terms now, the markets have already factored in most of the trouble and most of the uncertainty. What would actually turn things around for Greece now?
Okay, I mean, I think the markets haven't factored in something that could happen, which would be a Greek exit from the euro. I think that would be really quite strong in its contagion risks, particularly for the banking sector, potentially in Southern Europe, and also for other markets. In terms of what could work out more positively here, I think what the financial markets always would say is that they want to see a clear roadmap to fiscal union. And ultimately, I think this entails political union for the euro area. And that involves euro bonds. They have to be on the roadmap at some point to get euro bonds. I think Germany needs to feel much more assured. One thing I would say about Germany is that it is only 27% of Eurozone GDP. The size of its government debt is only marginally higher than the size of Italian government debt, for example. So we shouldn't think that Germany is so dominant in this that it can really offer a complete anchor and support. It has to be careful, I think, itself over exactly how it can proceed, which is why it is playing a cautious game. And of course, there are all kinds of laws, the German constitution, the EU treaty, which also Germany is paying attention to.
But you're saying that even if Germany, very briefly, even if Germany could step in and, if you like, with a Superman T-shirt on, save Greece, if the same thing happened to Italy, it'd be a totally different story, and it wouldn't be able to.
I think it would be overwhelmed by a combination of Italy and Spain. That's right. And that's why it's really important. And thankfully, I would say Italy is being very responsible here. It hasn't been running particularly large budget deficits, and it's got very clear targets in mind to reduce its budget deficit such that the debt-GDP ratio will be falling. And we all have to be extremely thankful in Europe that that is the case.
Okay, we're nearly at our time. Let's go back to Jemima, just see if there's a couple more questions we can put to the panel here. Jemima?
We've got some very demoralised Greeks, as you can imagine. And there's Dimitri Dafalias on the Google Plus page saying, "We are being terrorised in Greece with threats that if we leave the euro, we will starve. The problem is we already are. Isn't the point that either way, Greece is broken?" And someone who's just visited Greece recently, Christina Bridge on the Google Plus page again, "I have recently returned from Greece. Austerity there means families living on £500 a month. How can governments expect people to live on so little?" And then there's a counter view, just to end, which is from Richard Partridge on the YouTube page, who says, "Surely austerity just means living within your means. If we'd done that all along, would we be in this mess?
OK, so that was Martin's initial point of fiscal responsibility, austerity by a slightly milder, more positive name. Let's go to Eric Jones on those questions from Dimitri, first of all. Eric Jones, what kind of future can you see for Greece when this is how people feel, that they're damned if they do and damned if they don't?
Well, I think the future is bleak. I think it's bleak in the sense that you have a huge generation of young people who are not getting access to experience in the workforce and who are not developing their skills as a consequence. And we're going to see a lot of those people leave the country. We're seeing them leave other countries in the Balkans as well. And we're also seeing young people leave Ireland again after a historic return. I think in this conversation, we've neglected the Irish case a bit. Remember, Ireland had the worst debt to GDP ratio in Europe at the end of the 1980s, and it got all the way down to 23% of GDP in 2007. Now it's back
with the help of austerity.
With the help of austerity, but much more with the help of growth.
Investment.
And investment. And yet all of that progress was reversed in the context of this crisis. So we have to ask ourselves, are we really talking about the origins of this crisis in this debate? Because if we're not, if we're talking about austerity and debt, we're only treating the symptoms and not the illness. And until we learn to treat the illness, we're going to see this situation in Greece repeated time and again.
All right. I'm going to let our advocates now bring us to a close of this debate. You, Oliver, have 2 minutes to sum up from what you've heard, what you've learnt, and make the case that austerity is not the answer.
Emily, I'm not going to rest complacently on the information that only 4% of viewers opposed this motion. I'm going to point instead to the overwhelming consensus of economic argument that we've heard over the last hour and a half, born not only of economic theory, but of basic history and facts. We've heard some fantastic misconceptions from the other side. The notion that the proponents of this motion are motivated by a socialist agenda, when I'd argued for the productive potential of competitive markets. The notion that this is all about the euro, a dead currency. The euro is not a dead currency. It is in many respects a success. It is a reserve currency, the only feasible competitor to the dollar. The problem that Europe has is that it isn't growing, and the reason that it isn't growing is a misapplication of policy. Austerity of a very hardline variety that is choking off growth, whereas actually getting budgets into primary surplus and restructuring debt and making necessary structural reforms to economies that have neglected them for far too long, all of this is much easier if it is tackled with a commitment to stimulating demand by monetary means, particularly if fiscal means are not available. The idea that the euro is a busted flush is an ideological misconception, along with the entire opposition to this motion.
Oliver Camp, thanks very much. You have the last word, Martin van der Weer. You disagree with the motion. Austerity is not the answer. Tell us what you've learned.
Thank you very much indeed. Well, let me appeal to the 20% of don't knows on the first vote, because actually if you've listened carefully to these arguments, particularly if you're part of that wave of doubters about the future of the euro that Jemima reported on, then you can, in fact, multiply my share of the vote by 6, which would be a considerable achievement. So bear with me to the end. Well, we've heard interesting arguments on both sides there, and we've heard quite a lot of nonsense, quite frankly. We've had some rewriting of history from Ian Golden. We've had some emotional special pleading from our friends in Greece. We've heard a bizarre conspiracy theory from my opponent. I wrote down, that is the intention behind it. That is to say that somehow the intention of austerity is to drive down living standards for some other conspiratorial purpose. What nonsense. I am simply making the case, as I said right at the beginning, for sound government. The euro is a fractured structure. It may ultimately come apart. I don't expect that in the very near term, but it's very difficult to fix a thing that was so ill-conceived in the first place. I don't wish it ill, I just make that observation. In that case, and if it's the case that the Germans are simply not prepared to underwrite a new wave of debt for Europe to provoke growth by that mechanism, then the member states of Europe have to fall back on sound government, fiscal responsibility, collecting taxes, spending frugally, reforming their private sectors to make them more competitive, being sustainable in every sense. That's what I mean by austerity, and I hope you're going to vote for it. Thank you very much indeed.
Martin van der Meer, thanks for summing up like that. Well, the final voting will open on the YouTube page as soon as we end this live stream. Do stick around and vote. We'll post the result as soon as it's ready. Let me remind you how things stood at the beginning of the evening. Around an hour and a half ago, 76% were in favour of the motion, austerity is not the answer. 4% were against that motion, 20% didn't know. So tell us how you feel at the end of the session. Have you been swayed tonight? Should Europe change course? Is austerity the answer? You've heard the arguments and now it's up to you to decide. I'd like to thank all our brilliant speakers, you, the audience, Intelligence Squared and Google for making all of this possible. And do remember we have a big event coming on June the 26th. Hip-hop on trial. Hip-hop does not enhance society, it degrades it. We'll have leading rappers, intellectuals, social commentators, and a very relieved political panel here that they're not doing that one. It'll be an extravaganza of debate and contention. Do remember to tune in to Versus for this spectacular evening of confrontation. We'll see you next time.